Wall Street is buying single-family homes. Should you care? Prior to the 2008 global financial crisis, single-family rentals were a mom-and-pop asset class, one that went largely untouched by institutional investors. In 2012, government-sponsored mortgage guarantors Fannie Mae and Freddie Mac launched a pilot program that encouraged large-scale investors to purchase bank-owned properties. As a result, institutional investors purchased over 200,000 single-family homes worth an aggregate $36 billion between 2011 and 2017. This figure nearly doubled in 2021 alone, when investors earmarked over $60 billion to buy single-family rentals. In February 2022, institutional investors accounted for 28% of all single-family home purchases, a record high since 2011. Though rising mortgage rates and other economic headwinds in 2022 have dampened institutional appetite for homes, the trend is clear: Wall Street will continue to buy single-family real estate. Morgan Chase recently announced plans to invest $1 billion in build-to-rent single-family homes via a joint venture with real estate investment firm Haven Realty. Likewise, Invitation Homes, a spin-off of trillion-dollar asset manager Blackstone, recently secured a $1 billion interest-only loan from Fannie Mae to buy single-family properties, a purchase that could add thousands of new units to the firm's existing portfolio of 85,000 homes. Single-family rentals have transformed into a mainstream asset class for institutional investors because it benefits from strong demographic tailwinds, is exceptionally resilient during economic downturns, and offers the potential for higher returns. On that note, let's take a closer look at the driving factors behind Wall Street's foray into the single-family market. As older members of Generation Z join their millennial counterparts in the workforce, they're shifting their preferences from crowded city apartments to more spacious and private single-family suburban homes. As lengthy commutes become less common, young adults, many of whom no longer need to live in close physical proximity to their workplaces to shave down commute times, are moving out of the city in search of larger and more affordable living spaces. As these mid-career professionals shift their focus away from work and towards their young families, they're prioritizing greater work-life balance, safer surroundings, and higher quality schools, amenities that single-family rentals in suburban neighborhoods handily provide. While there is no single explanation for this phenomenon, there's one cause that stands out: soaring home prices and higher borrowing costs have thwarted millennials' ambitions of home ownership and fueled the demand for single-family rentals. Given this surge in demand, it's unsurprising that rents commanded by single-family homes have risen faster than multifamily apartments, and it's for this reason that institutional buyers are flocking to purchase single-family properties in droves. The abundance of data and the availability of technologies that can streamline data-driven decision-making has also contributed to the institutional foray into the single-family asset class. Today, sophisticated real estate investors on Wall Street can partially or fully automate the process of appraising, acquiring, renovating, leasing, operating, and maintaining single-family rentals, leading to lower vacancy rates, higher net operating income, NOI, margins, and greater tenant satisfaction. In short, this means that institutional portfolios spanning tens of thousands of single-family properties may not only be practical, but also profitable due to economies of scale. However, with $110 billion earmarked by institutional investors for buying and building single-family homes, the share of institutional ownership is poised to increase markedly over the next decade. Investment firms on Wall Street have been buying single-family homes aggressively since the onset of the pandemic. Buyers who essentially played the part of large-scale home flippers spearheaded this trend, but soon, large institutions began to purchase and hold these homes for the long term. In fact, by the third quarter of 2022, 25% of all homes sold by flippers, both small-scale flippers and large iBuyers, were bought by large institutions. While this can be ostensibly explained by the decline in demand for single-family homes by smaller investors, a more worrying explanation lies below the surface. Cash-rich institutional heavyweights are competing with individual investors and home buyers over a limited supply of homes and squeezing them out of the market. After all, institutional investors aren't just buying existing homes, they're also building new ones. In summary, Wall Street's interest in single-family homes can be chalked up to its potential as a profitable asset class bolstered by secular demographic tailwinds. If you're a prospective home buyer or investor, personal factors like your risk tolerance level, Your budget, and your locations of interest are arguably even more important. And with home prices expected to further decline into 2023, now could be a prime opportunity to buy so that you can build equity, generate rental income, or simply have a place to call your own.